Okay. So the next ratio is price to earning ratio. Okay. So the name itself, price to earning ratio, with the name itself we can understand what this ratio is all about. This is nothing but price here means market price. So PE ratio, that's what it is, correct? So price to earnings. You know, earning is what? Earning is nothing but EPS. You have already done the EPS concept. So earnings is nothing but earnings per share or basic earnings per share. So very simple. So in price to earning ratio, we are discussing or we are seeing the ratio of market price to EPS. Very simply understood. Market price to EPS. We are seeing that we have invested $100 on a share, and that is the market value at present of a share, and the earnings what we made with that investment. See, what is earnings per share? If suppose my company has earned, let's say, $50 as profits, and there are 10 shareholders, let's say, so each shareholder is getting $5, correct? That is earnings per share. So what I'm doing, the market price is this, the earnings is this. So my ratio is 20. Okay. Now what does this mean? See, this particular ratio which I'm discussing with you is a very important indicator of the future prospects, what you can see in a company. Okay. That means what kind of future you see in a company in which you want to invest. That can be known by seeing the PE ratio. That means you should compare the current year's PE ratio with the previous year's PE ratio. With that, you can easily understand what kind of potential the company in which you have invested or you want to invest is going to have in the future. Okay, because the higher the PE ratio, okay, the better it is, it seems. If let's say the PE ratio is high since 3 years, and this year is also high, and let's say since 4 years the P ratio is high, but the profits in this year have declined, then also it can happen. See, decline in the profit is not loss. You have earned 10, you have your profits in the previous year was $100. Maybe this year your profit is $80. It doesn't mean that you are in losses. You have still made positive figures. So the point here is, if the current year is also not that satisfactory, still the company has good prospects in the future because the P ratio is high every year. Okay. So what does see what do you mean by high P ratio? See, when you see this numerator market price, the market price, what is going to be the market price of a stock is solely decided by the market participants, that is the people like you and me who want to buy a company stock. So we will decide what a company's stock price should be in the coming years after its issue. Okay. So how we will decide? We will check about we will check the company's profile, how the company is like performing since the inception, on whether the company has got some good projects. We got some report that company is going to get some government projects like dam construction. Once a company gets a dam construction project, it is it is going to be very good. Like that is going to be a very good news for the potential investors. Why? Because when you get such kind of government project, 10 years, there's no doubt that you'll be like suffering for any kind of payment issues or something like that, because government will give you prompt payments, and your company has got a very big business for 10 years, or some flyover project or some train project or something like that. See, these kind of projects would boost the morale of the potential investors. Why? Because they get a good news about the company. That creates a perception among the investors that this company has bright future, and they will be ready to pay a higher price for that company because they think the future earning power of the company is high. Okay, even though not right now, but in the future it may be high. Or company has invested heavily in in some new or latest technologies, like Tesla, electric cars they are selling. Elon Musk, did you ever imagine this guy would come out of the blue and become the richest man on the planet? No, it was not seen like that. And like you see LG products, they always sell whatever the LG electronics you are buying, the products of LG electronics, they spend $1 or $2 billion solely on innovation. No other company does that. So you see always some of the other things, some innovation they bring there in product, and that is their USP. They sell like that. So let's say the company in which you want to invest has paid off its debts. So that also means that company would be there's less debt burden on the company. Okay, so all these factors would be in the favor of company, and it will drive you to invest in that company. So that's the reason why a higher market price in the numerator in the P ratio is an indication that the ratio would be high. Why? Because if the numerator is high, the ratio definitely would be high. If the denominator is high, the ratio would be less. Okay, so market price should always be very high. That means the increment in the market price should always be way higher than increment in our earnings. Understood? Earnings is just a uh, like satisfaction that the company with which you're continuing is a profitable company. But market price is about the market perception. So people are ready to pay some hefty amount, or whatever amount you quote, or whatever. See, we say now, like we can make bakra of someone. That means 100 rupees ka item we can sell for 150, when in actuality it is not that worthy. Okay, so it is like that. People may be ready to pay whatever amount for a property if it is in a prime area. That's what. So people will be ready to pay whatever amount for a stock if it has very good demand in the market of this, if they see good prospects of that stock and it is not easily available in the market. That means they have to buy from some broker, and brokers would be approaching you by knowing that you hold the stock. So all these factors are very important for an investor. So P ratio is a very important ratio for investor. That's the reason why I'm giving you so much of lecture on this, because this would decide a company's fate or future, and it is very good forecasting tool. Okay, so market price by EPS is the formula. So can you just calculate the P ratio of this? Please do this. I'm writing the formula. PE ratio is market price of a share or per share by earnings per share. Okay, come on, do this. Madam will correction. Correct.
Yes, sir. Hello. Hello.
Yeah, Kalyani.
Yeah, okay, okay.
Yeah,
Three,
you were
right?
saying something, madam.
Yeah, answer is
Answer is
3.
three.
3. Okay.
Yeah.
So what is your
Market
par
price per share
market price is 108.
108.
What is your basic EPS? 36. Yeah, finished. Chalo. Next. Why did they give such easy question? Now,
There will be complicated questions.
yeah, we will see that kind of questions. Earnings yield. So when I speak about yield, I always what should come to your mind is market price. That's it. That means, see, every investor would want to know for $1 investment what he has done, how much is he getting. That every investor wants to know. Suppose if I spend $100 for a stock, and the EPS or the earnings what I got being a shareholder, because I invested $100 for a stock and my earnings for one stock is $10. So definitely what I understand is, for $1 invested I have made how much of profits?
100.
10 cents. because it will be 1 by 10, na?
Yes, yes, yes.
1 by 10 into 100 if I do what? 10%, isn't it so? Zarina, are you following? Hello? Zarina, are you following? Okay.
Yes, sir.
Yeah, okay, Zarina. Okay. So what do you mean by this? So the earnings yield is what? For $1, how much you got?
10.
10 cents. And when you will be more satisfied? You would be satisfied if previous year on $1 you made 8 cents. And this year for $1 you made 10 cents. That means this year your yield is more than previous year. So you are more satisfied. Now comes the dividend yield. See, dividend yield is nothing but, see, $10 is my earning, $100 is my stock price. And company has declared 10% as dividends. So this out of $10, $1 goes for dividend. Correct or wrong? Yes?
Couldn't get it, sir.
Sir, can you
See,
please?
my EPS, earning per share, is $10.
Okay.
Company has declared that they will give 10% dividends. What do you mean by this? That out of whatever earnings or profits the company has made, they want to give 10% dividends to their shareholders. So from your earning, they are giving you dividends or not?
Yeah, they're giving.
You made $10 as earnings
Yes,
for one
yes.
share, for one share. So 10% of this is $1, na?
Yeah,
That is
yeah.
your dividend per
Yes,
share.
sir.
Yeah, so dividend yield is nothing but dividend by market price. See, earnings yield is EPS by market price, MPS, and dividend yield is DPS by EPS, MPS. Okay. Now,
Market price.
yeah, if at all dividend payout ratio is DPS by EPS, that also we will discuss. DPS by EPS. Why? Because $1 is what they have declared. See, 10% dividends they have declared, na? So $1 it is in monetary terms. $10 is your earnings. So what is your dividend payout ratio? 10%. Correct or wrong?
Yes.
Isn't it so? 10 you'll get. 10 into 1 is 10. So 10% is your dividend payout ratio. So dividend payout ratio is nothing but out of $10 of EPS, I am paying $1 of dividend. That is 10%. Na? Finished.
Yeah.
That is dividend payout ratio. So this also got covered. I'm covering this one, dividend yield. So if $1, let's say if I say $5 is my dividends, let's say, see, don't take this $1. Okay, I'll take that only. $1 by $100. So for $1 investment, I've got 1 cent as dividend. Correct or wrong? Which is 10% of 10 cents. Isn't it so? Hello?
Which is 10% of 10 cents.
Yeah, 10% of 10 cents is 1 cent. See, this is 10 cents into 10% is what?
1 cent.
1 cent. So let us like clearly understand this. I'll tell the story. Company, you invested $100 for the stock, which has what has happened is which has given you a earning of $10. Now company won't give you your earnings totally in your hands. They will retain some part of this and some part of that they will give you as as earnings. That is called dividends. So company declared 10% dividends. That is $1. Can I say that is DPS? Dividends per share?
Yeah.
Yes.
Yeah.
Yeah.
So now your the stock is this, EPS is this, and DPS is this. So earnings yield is what? EPS by MPS, market price. So $10 by $100. So it is
Yes.
$1. On $1 you made 10 cents. Now dividends yield is nothing but DPS by MPS.
MPS.
That is $1 by $100. So on $1 you made 1 cent. Correct?
Yes.
Correct or wrong?
Yes, sir.
Yeah,
So
yeah.
this 1 cent is what of 10 cents? 10%, na?
Yeah.
Understood fact, because they declared 10% dividends to you.
Yeah.
So,
Yeah.
so that is also justifying. And your dividend payout ratio is what? $1 is dividend, $10 is EPS. So 10% of 10% they have declared as dividends. That's the reason why that is $1. When you do, when you multiply this 10% with $10, what do you get? $1, na? That is your dividend. So the company has given 10% dividends to their shareholders. That is dividend payout ratio. That's it. So all the three ratios you have understood. Please go through this. Any doubts you can ask me. If still you are not okay, I can neatly write in one more page and tell you. If you are okay, then I'll move forward after this three.
I guess with the sums we will be able to understand properly.
No, we will do with the sums also. Once like right now, if you have any doubts, you can ask anything if you want to.
Okay, can go forward.
Yeah, this is okay, na? EPS, sorry, earnings yield, dividend yield, and dividend payout ratio. All are clear. Shall I move forward?
Sir, 1 minute, sir.
Yeah,
I
please.
want to write.
Yeah, you can take it. That's what I'm saying. If someone is struggling to see all this numbers, if they want, I can put it neatly on some other page.
Yeah, you can write it neatly, sir.
Yes, sir. You can write it.
That's what I'm asking. So earnings is $10, market price is $100. Earnings yield is 10%. Correct? Or on $1 you made 10 cents. Correct or wrong? For $1 investment,
We get 10 cents.
we earn investment in stock, we earn 10 cents. So what has happened is $10 is the earnings, and earnings is equal to $10, and dividend declared is 10%. So what is that? $1, correct? How you got this? $10 into 10%. So $1 by $100, 1%. What does it mean? For $1 investment in stock, we get 1 cent as
Dividend.
dividend. So every yield measure should be such that when compared to previous year, if this year you are getting more, you should be more than happy. If you are getting less, then you should rethink of continuing with the company. Okay. See, your dividend per share is how much? $1. Your earnings per share is how much? $10. That means company is paying how much percent of your earnings as dividends? 10%. That is dividend payout ratio. Okay, please do this.
Okay, so go ahead.
Yeah. Now we'll discuss about shareholder return. See, suppose you bought a stock for $100. I'll say that as P naught. And let's say the stock price right now is P1, like $150. And company has given you a dividend of $10. So what happens is I'll divide this into two parts. How? The formula would be, right on the formula, ending stock price is P1, beginning stock price is P naught, and dividends is D, whole divided by P naught. That is your share return. That is total shareholders return. Come on, write on this formula.
Ending stock price minus beginning stock price.
Beginning stock price plus dividends. Okay, so now what is it like? I have to explain you. See, if you see only in one angle, like P1 is 150, P naught is 100 divided by P naught 100. So how much you got? 50 by 100, 50%. Correct or wrong? Please tell me.
Yeah.
This is capital gain. What is that?
Capital gain.
So capital gain
Capital gain.
plus dividend by share price. That means if I divide it in this way, P1 minus P naught by P naught plus D by P naught. Can I write it in this way? I can definitely write. I have split this ratio into two parts. This formula into two parts. Dividend by share price is what? Dividends yield, correct?
Yes.
That's what it is. That's it. So your return is not only the capital gain what you get. Your return is also the dividend what you get on the shares. Understood?
Mm-hmm.
Apart from your capital gain, what you should also get? Dividend yield. Understood now? It is not only the earnings yield which is important, dividend yield is also important. That's what I wanted to explain you. Here earnings yield is not there, capital gain is there purely. Now, so I'm moving forward if you're done with this. Shall I move forward? Yes, confirmation.
Yes, sir. Yeah.
Okay. Now do this question. What is it?
Can you do it, sir?
You can't do this. So Trot Holdings is considering the acquisition of Sawmill Publishing Company with common stock. That means they want to acquire this company by issuing some stocks to them. Following financial information is available regarding the two companies. Net income, you can see Trot's is this and Sawmills is this. So this is 8 million, 2 million, okay, net income. And common shares outstanding is 4 million. And this is 1.6 million. And they have divided this 8 million by 4 million to get the EPS. They've got it. P ratio also is given to you. So this and this. Trot plans to offer Sawmill shareholders a 20% premium over the market price of the Sawmill stock. That means they are ready to pay 20% more to what?
Sawmill
Yeah.
stock. That means.
Yeah, so they are ready to pay 20% premium over the market price of the stock. What would be the EPS for the surviving company immediately after the merger? Okay. So they are ready to pay 20% more than the market price. So first you need to get the market price, na? Do you know what is the
Yeah.
market price? So market price by EPS is PE ratio. Am I right?
Yes, sir.
So market price we don't know. EPS we know. What is that? 1.25 is equal to 8 multiply.
8.
So market price per share is 10. 20% of this is $12. So Trot plans to offer, so they are ready to pay $12 to Sawmill. Just a second. Just a second. Yeah. So now I got the market price. What would be the, so now see, this is the market price, correct? So now you have to find out the EPS. So how will you find out the EPS?
Net income minus return.
Sorry.
Net income
So
minus return by weighted hours.
no, this is the mark. So Trot plans to offer Sawmill at 20% premium over the market price.
Earning per share, we have it, right?
Trot plans to offer Sawmill shareholders 20% premium on the market price of the Sawmill stock. What would be the EPS for surviving company immediately following the merger? Now, after the merger, these two are the surviving company. What is the surviving company? Trot plus Sawmill, correct?
Yes. Both are matching.
So EPS of the surviving company in the sense, then you need to add up these two.
Okay. 8 plus 10.
12 plus 8.
12 plus 10, 22.
Earning per share, we have to add it, na? 2 plus 1.
Yeah. So earning market price is $10 now. So we have to find out EPS. EPS is equal to like IAC by Vansco, income available to common shareholders by Vanso. So first, that means they are paying more premium, no?
20%.
So market price we got how much? We got $10. Previously the market price was this. So market price, if I take, because I want the surviving company. So here I just copy the EPS once I immediately are following the merger. EPS is equal to market price per share by PE ratio. That can give me the EPS. So market price of the surviving company, the total market price can be $10 we have found out here. What is the market price here? 12 is equal to market price per share by 2.
That is price
24.
earning ratio.
24. So 24 plus 10 is 34. That is market price. I'm just
I
trying.
couldn't get it, so
No, just a minute. I'll just explain. 2 minutes. 4 by okay. So EPS is ISE by Vanso. Correct?
The ISC we can take 8 plus 2 or only
Yeah, 8 plus 2 only we can take.
10 minus.
Just a second. They are paying extra now, so let's say okay. Transfer is 4. 56. $1.785. We got the EPS. But the thing is, where did we? They are paying 20% premium over market price. So one more formula we have, I think, for EPS. No, EPS earnings per share is this only. If this is not the way, then like I have also found out this by putting the premium thing also I found out. What is that I found out here? 20% premium they said, no? So I took how much? 10 I got, correct?
Yes, sir, 10.
So $12. $12 is my stock price.
price.
So when $12 is my stock price, $12, and here 24, 32, 32, 32, and here market price by market price is, what is the market price I got?
10, sir.
10, no?
10.
10 I got, and again like 12. So market price is 12 for sawmill, and for this company it is 24. Correct? Correct, na? Because market price formula is what? P ratio into EPS. So P ratio into EPS is nothing but 24. Here it is 10. 10 ka 12. So 36 is my this one. Okay?
EPS.
Yeah, EPS. No, no, EPS not. 36 is my like market price. So
In the
total EPS is
20% premium is this.
yeah 36 by 20. This is the see no the thing is what I'm let's see what they have done 23. Yeah, I got the same thing only.
Okay.
I got the same thing right now. And for this, as it's premium, it will become 12 only. So we got this only, na 24 and 12, 36 only we got, correct?
Yes, sir.
Isn't it so?
Yeah.
Hello?
Yes, sir.
Yes, sir. Step by step. Taken.
We got 36. Now
Total purchase price
the
will be
total purchase price will be 12. Okay, they are finding out the purchase price. Acha, okay, understood. Okay, it's a very big question. I'll explain you how to go about that. See, first of all, we don't do we have the idea regarding the common stock of both the companies? Did they give
Yeah, it
market price?
mentioned.
No, na?
no, sir.
Did they give market price to you?
No, no, no.
No. So how did you find out the market price? Market price is EPS into P ratio, correct? Okay, one that is 1.25 into 8, so $10. That is the market price of sawmill, correct?
Yeah.
Yeah,
And with 10 like how much premium they are giving 20%, so it will become 12. That's okay. So sawmills
So,
market price is 12. One thing we got. And other guys market price is how much, like that is 24 maybe, because 12 and 2, the total purchase price will be 12. No, no, at market price, yeah, trot stock. So trot stock will be market price will be 24. Why? Because 12 into 2. 12 is the P ratio, 2 is the EPS. So 24 we got. So this 12 and the 24 we got, correct? Now, who
yeah.
is buying whom? Trot is buying
Saman.
Sawmill.
sawmill. So Trot, if Trot has to buy sawmill, they are buying sawmill at some premium amount, correct? They are paying more price to them. Isn't it so?
Yeah.
That we have already captured. So if Trot wants to buy sawmill company, so Trot has to buy sawmill stock, correct?
Okay.
Correct
Yeah,
or wrong?
Yeah.
They have to buy sawmill stock, na? Or they have to buy sawmill company. So what is the value of sawmill company? See,
24.
if you want to buy some company, you will ask the value of that company, na?
Yeah. Yeah.
If you are going to a shop and want to buy a mobile phone, you'll ask the value of a mobile phone. In the same way, when Trot wants to buy sawmill, they are valuing they are calculating the company's value. So how will you calculate company's value? You'll see what are the outstanding shares into market price. Correct or wrong?
Outstanding
Come on,
shares.
yes, tell me.
Yes. Yes, sir. Yes, sir.
So sawmill's outstanding shares are how much? 1.6 million or 16 lakhs. And what is the price that sawmill is paying to sorry, the Trot is paying to sawmill? So 1.6 million is the outstanding shares of sawmill, and what Trot is paying to them is not only their share price but also 20% premium, correct? So actually the value of sawmill is 1.6 million into 10, that is 1 crore 60 lakh something. But since Trot is ready to pay 20% premium, they are ready to pay 12 rupees for one stock. So what will be the value? 1.6 million into 12. So value will be 1 crore 92 lakhs. How much? Come on, tell me yes or no.
Yes, sir.
Hello.
Sir, one more down.
All of you are following or not?
Yes, sir, we are following.
Following.
Following, no? Yeah.
Yeah.
So now, 1 crore 92 lakhs is what is the value of sawmill company which Trot will buy. So how will Trot buy is, this is not paying cash to sawmill. Trot will give their stocks to sawmill. Okay. So if Trot would buy the sawmill company with whose value is 1 crore 92 lakhs, this is the value of sawmill. They will take their shares, sawmill shares, and give like Trot shares. Okay, so I will write it here. So
Sir, they are
$12.
exchanging, sir.
Yeah, share exchange only. $12 is sawmill stock. $24 is $12 is like Trot paying to sawmill. $12 is Trot paying to sawmill. Okay. So this is like Trot stock. And how much is the value? Like this won't go like this because we have already found out the value. So because we took 1.6 million into 12 we did, that's the reason why we already got the value, that is 1 crore 92 lakhs divided by Trot stock 24. So we will get these many new shares Trot has to issue. Okay, to buy sawmill, to buy the sawmill company, Trot will give its shares, okay, to the shareholders of sawmill, and if the shareholders of sawmill will get shares of Trot, they'll become a part of Trot. That's it. So how many shares Trot has to give to sawmill? 8 lakh shares.
8 lakhs.
That's okay. Now the total number of Trot shares outstanding is how much after its merger? Already Trot has these many shares plus newly issued 8 lakh shares. So 4 lakh 48 lakh shares are outstanding of Trot in the market now. Now what is the combined net income of Trot and sawmill? This one. This divided by the outstanding shares would give you 2.083. Okay. Don't worry. I'm solving this entire question neatly for you and explaining you everything again. This would be somewhat complicated question because you don't have that much knowledge of acquisition, merger and anything. If you have done group accounts in your BCom, somewhere around you will be knowing about this. See, listen, I'll explain you everything. I'll open a new copy. 2 minutes.
Sir, please write in a new place.
Yeah, no. I'm opening a new copy only of this. There I'll do neatly.
Sir, if you can, that question, first company is merging second company.
Yeah,
Then what is
yeah.
the
First company
share
is
value
buying
of
second.
first company? Yeah,
Yeah, Trot is buying this thing.
Raman.
Yes.
Then what is the share value of the Trot? He's asking like that.
Why it is coming again like this? I wanted this in neatly actually. Okay, I'll explain you here. See, try to understand. See, Trot is buying sawmill, correct?
Yes.
Trot is buying sawmill. So when Trot would buy sawmill, it can like buy sawmill in many ways. Either it can give cash directly to sawmill to buy, or what Trot is doing is what they are doing is for every stock of sawmill they are paying 20% premium to buy this sawmill company. Correct or wrong?
Okay.
By taking that 20% premium into consideration, we are going to find out the value of sawmill now. Okay. So for finding out the sawmill's value, first we want sawmill's stock. So the formula for market price is nothing but EPS into PE ratio. I explained you how I'm finding
Yeah.
that one, correct?
Yes, yes.
So what is the EPS of this this like sawmill like 1.25 and P ratio is 8.
Yeah. They're almost
Where is that?
before.
Yeah.
Yeah.
1.25 into 8. So $10 is the market price of sawmill. But this Trot is paying 20% premium for sawmills each stock. So that will make it $12. Am I right? So now Trot is paying $12 to each shareholder of sawmill to buy their shares. Am I right?
Yeah.
Correct now?
Yes, sir.
You can see here. Trot plans to offer sawmill shareholders 20% premium over market price of sawmill stock. That's what. So this is a particular type of merger. Now what will happen is, next coming thing, we will try to find out the value of sawmill, because if Trot has to buy sawmill, first we should understand what is the value of sawmill company, correct? Actually, before this merger, the value of sawmill company would have been 1.6 million into $10 per share. That is before merger. Because they have 1.6 million shares in the market and each share price is $10. But after merger, their value is how much? So 1 crore, this is like, this will give you 1 crore 60 lakhs. Here 1 crore 92 lakhs. That is one something, some value we have got now there. How much? Like I'll see. Into, yeah, 1 crore 92 lakhs. So this is the value of sawmill. Okay. Now to pay this, what these guys will do, Trot, they'll do a share exchange. That means they'll give their shares to this one, sawmill, correct? See, acha, okay, see. If now these two companies have to become one, these two companies have to become what? One company, correct?
Yes.
So what I'll do is I will divide this in terms of Trot share and see how many shares this is getting converted into, correct?
Okay.
See, this is in terms of dollar amount, na?
Total dollar amounts.
This is in terms of dollar amount. Now, what Trot has to do? Trot has to issue shares to sawmill shareholders. Am I right? Trot has to issue shares to whom?
Sawmill shareholders.
Sawmill shareholders. So what has Trot done is, Trot has asked sawmill's value. What is your value? Come on, tell me. Your value is this much, na? Okay. Now, Trot has to decide how many shares based upon his market price of 24. He has to issue to Trot to buy Trot company. He has to issue to sawmill to buy the sawmill company. Correct?
Yes.
See, if I want to buy some, see, if I went to a shop, mobile phone shop, and I asked the value for mobile phone. So he told that mobile phone value is 10,000 rupees. Now I asked him, I don't have cash, but I have some stocks. Each stock value is 25 rupees. How much?
25.
Come on, tell me.
25 rupees. Sir.
So now how many stocks I have to give in exchange, him in exchange to buy the 10,000 rupees mobile? Divide and tell me.
400 shares.
400 shares. So I will give 400 shares to the mobile shopkeeper and take 10,000 worth mobile from him. Please tell me, did you understand this concept?
Yes, sir, I understood.
For the time being, you understand you don't have money, you don't have shares, you have gold. Okay? And your gold value is, suppose you have a gold value of like 5,000. That means you have a biscuit of 5,000 rupees. So how many biscuits you'll give him to buy one mobile phone?
Two biscuits.
True.
Come on, Suman, you are not answering, and Zarina is not answering. How?
There is so much of confusion in this problem, step by step.
I'm trying to simplify that for you. See, I'm trying to bring every layman terms here. I'm saying I'll give 2 biscuits to that guy and take a mobile phone from him. I'm saying that I will give him, if I speak about shares, one share is trading at 25 rupees. One of my shares is trading at 25 rupees in the market. So I'm saying that I don't have cash. I carry stocks. I will give you stocks and I'll take mobile phone from you. So now, the next question would be, how many stocks I have to give to him to take the 10,000 rupees mobile phone? Definitely, I'll ask the mobile phone value divided by 25, which is one share worth what I have. So I get 400 shares. Or in the same way, if you don't want to go into that complication, 10,000 rupees is the mobile phone, and I have a biscuit of one biscuit of 5,000 rupees. I'll give him how many biscuits? I'll divide this by 5,000 rupees. What comes out is two quantities, 2 biscuits I'll give him. Correct. So in the same way, by 24 would give me 800,000 shares. So I'll give him 8 lakh shares. That means Trot will give Sawmill 8 lakh shares to buy Sawmill. Understood? So now Sawmill is with Trot, and Trot also has its own outstanding shares already existing in the market. So we will take the outstanding shares of Trot and how many shares they give to Sawmill to buy them. So it will be 4.8 million. Yeah, 4.8 million. And we will see the combined earnings of both the companies. So 8 million plus 2 million, that is like 100 million, maybe 1 crore. So that 1 CR divided by 4.8 million will give you what? Please calculate and tell me. And give me 2 minutes of time. I'm having some water. I'm waiting for the answer. So what is the answer you got?
2.08.
Sorry?
2.08, sir.
Yeah, 2.083 is your answer.
Hmm.
Yeah, now you can write step by step, then I'll move forward fast.
Can you scroll to the solution, sir? That would be easy for understanding step by step.
This is the one I did, na, right now.
Yeah.
You mean to say you want that answer option to be shown, or this one you want?
He's asking last question.
Last page. Okay, you can tell me if you want. I can scroll down that one. You want last page? Hello.
Yes, Suma.
Yes, sir. So in this kind of problems, what is the first basic calculations we should
Market
go?
price. That is not there, no?
Okay.
Without getting the market price, you cannot find out the value of sawmill company. Once you get the value of sawmill company, you understand how much shares you have to give them to buy them. Now you get outstanding shares. When you have outstanding shares, you have your income. You can find out the EPS.
These type of questions is only for 1 mark questions, sir.
No, madam.
On this comes under
Your
this.
each question is 4 marks, I think.
Calculate.
Yeah, once done, please confirm.
So you have moved it up, I guess.
Oh, just a second. Sorry, sorry. All these touch panels, like. Done. Shall I move forward?
Yes, sir, I have taken the screenshot. Right.
Yeah, yeah. Okay, okay, okay.
Sir.
Hopefully everyone has understood. We'll move forward now. What is the page number?
70, 70 to 70.
Okay, got it. So we are done with this set of ratios. Now we have to enter into the solvency. I think all other things are almost done. Okay. These are all done now. This one, can you confirm equity multiplier? This one,
Which
this ROA, total asset turnover into net profit margin.
only ROA and return of equity is done. Only two things are done in that.
This one like ROA.
Return on assets also is completed now.
Sorry.
Return on assets.
That is done now, madam.
Yes, sir.
No.
The
Return on.
debt equity is pending.
No, that
That's
is that.
one.
We will do that one. I'm just asking, did you do this one? Sustainable growth rate.
No, sir. No.
We'll do this question now. Okay. See, you already have an idea about return on equity, correct? Sure, now this one, please check it out. Otherwise, my efforts again I have to put. This one done or not? Please check in your notes.
So only return on equity and return on assets are done. Only two topics covered. Sustainable growth rate has not covered.
Okay, I'm covering this sustainable growth rate. See, sustainable growth rate is what? I'll give you a small example. This is $100 is the company's earnings. Company declared a dividend of 10%. So dividends are now $10 and retained earnings is how much? $90, correct? Hello?
Yes, sir. Carry
Yes,
on.
Yeah, company has declared a dividend of 10%. So company is paying a dividend of $10 and company has retained $90. What would company do with this retained earnings? They will reinvest. So $90 is the retained earning. That is nothing but you can find out with this formula also. 1 minus dividend payout ratio is how much? 10%. Am I right?
Yes.
Yeah.
1 minus 10% is nothing but, I will tell you this one. Dividend payout ratio. What's the formula for dividend payout ratio? DPS by EPS, correct?
Yes.
We did not
Yeah.
that one. So your dividends per share is $10. Your earnings per share is $100.
So 10%.
1 minus dividend payout ratio. That means we are speaking about 1 minus the removal of dividend payout ratio. So what is left over? 100 minus 10 by 100. 90 by 100 is 90.
990.
So 1 minus 10% if I remove, I have 90%, correct?
Yes.
Right.
Or $90 I have, let's say. I am reinvesting that one at some 10% returns. So how much I will get? 9%. That is my sustainable growth rate. Please make a note of this. Or else you can write like this also, 90% into 10%. You will get 9%. That's it. %, and 9%. That is your sustainable growth rate.
So we are just dividing the dividend into return on common equity.
Yes. What dividing, sorry?
Multiply.
No, this is EPS, not
Multiply.
common. Yeah, multiplying, yes. We are removing the dividend payout ratio and what we are getting is nothing but the retained percentage. See, if 10% dividend is paid, 90% is retained. Na? That 90% what is retained is reinvested at 10%. So the growth rate is 9%. Did you understand what I said?
Yes, sir.
See, you paid 10% dividends. So you retained 90%. That 90%, whatever you have retained, you have reinvested at
Reinvested.
10% returns. Some stock or some investment option you picked up, which gives you 10% returns. So all in all, growth rate is 9%. Okay. Now, so you already know what is dividend payout ratio, DPS by EPS, and you know what is the or like if you want to take in total terms, total common dividends, like $10,000 is your dividends divided by the income. So here I am speaking per share wise, here I am speaking in totality. So income is 1 lakh, so 10% is your dividend payout ratio. And you already know the formula for return on common equity. From net income you have to remove preferred dividends divided by average common equity. Why preferred dividends? We are speaking about common equity.
Common equities.
So can you do this question, please? You have to find out the sustainable growth rate in this question. Come on, do this.
For which year we can calculate sustainable growth rates? No?
Sorry?
Previous year. For which year we can calculate the sustainable growth rate for previous
They're
year?
asking for what actually?
Yeah,
They're asking for the 2002, na?
2002.
Yeah.
Okay.
So the following are the selected items for XYZ Industries financial statement for the past 2 years. So if you want, like you can take 2002 into picture, and as they did not mention about which year, so current year only they mean. So you can find out the dividend payout ratio first. What will you do?
Dividend payout ratio.
Very simple to find out. You have that details given there. After finding out the dividend payout ratio, then 1 minus dividend payout ratio will give you sustainable like whatever 1 minus dividend payout ratio into what? ROE.
ROE.
Yeah, it will give you sustainable growth rate. To find out ROE, you have to find out average equity. For that, 2 years data is given.
Okay, you can add hours.
Yeah. So for finding out ROE for the current year, you should have net income of the current year divided by the 2 years equity, na?
Yeah.
Isn't it so?
Yeah, average equity no? For 2 years.
Yeah. You can do, then I'll do it. No problem. Should I do? Okay.
Yeah.
See, first thing is sustainable growth rate formula is 1 minus dividend payout ratio into ROE. Correct?
Yes.
Yes.
Yeah.
Yeah. So dividend payout ratio is nothing but DPS 1 minus DPS by EPS 3.84. So now calc 3. So 3.84 minus 1.20 by 3.84. Come on, do this and tell me. I think you'll be getting this.
0.31.
No, I am doing it directly. Don't compare this with that. Yeah, I am doing it. I'm getting this one directly. Okay. So what did you get?
3
Please tell me.
minus 1.
0.68, sir.
0 point.
3.
Just a second.
We won't get 3125, sir.
0.6875. Correct.
Yeah, 0.687, sir.
Yeah. Directly. I did directly. No need to follow the steps. They are very lengthy actually.
Yeah, into ROE.
Then ROE. ROE is nothing but net income minus preferred dividends divided by common equity we have to take. So what is net income of this year? Net income of this year is $60,000
Yes.
minus what is the preference share dividends? They have given preferred stock as how much? Preferred stock 7% cumulative par value $20, 1,700 shares. 1,700 into 20 is nothing but
20.
34,000. 34,000, 7% you have to do. How much is 34,000, 7%?
2380.
2380.
2380. So you have to do that. I think they have done that itself. Yeah. So 60,000 minus 2380 divided by average common equity. So average common equity is nothing but
75,000 plus
common stock. Sorry, madam.
common stock is 75,000.
Except this preferred stock, you take this,
Okay.
and this. 75,000 plus
So
45,000.
in denominator, we have taken
2,41,000. Sorry. This is 2,41,000. Tell me what is this? So that I'll just add this to and divide by 2. 75 plus 45
2 lakhs.
plus 80. So 2 lakhs. So 2 lakhs
2
plus 2,41,000 divided by 2 average.
2,20,500.
2,20,000.
Yeah, 2,20,500.
Yeah, 2 plus 2.41 divided by 2. 2,20,500. Correct?
Yes, sir.
60,000 minus 2380, 57,620 divided by 2,20,500. 57,620 divided by 2,20,500. So we get 0.261, correct?
Yes, sir. 0.261.
So like so 0.6875 into 2.613. How much? 0.179
1.79.
into 100. So 17.96% you'll get. Okay. That is nothing but what? Your sustainable growth rate.
Yes, sir.
That's it. Please finish this off.
Done.
Finish.
Yeah.
Hello.
Yes, sir. Finish.
Yes, sir.
Yeah. So we have finished this also. One of the sets.
The main thing, if we are able to solve the problem, then I feel that it's finished.
Yeah. That definitely will show you like what kind of varieties you have when it comes to questions. What kind of questions they're asking. So you'll be feeling more confident, of course. Definitely. Definitely. So now return on assets. Now please can you confirm like return on assets हो गया क्या? Done?
रिटर्न एन एसेट हो गया है और
So
रिटर्न ऑन इक्विटी भी हो गया है.
this is also
ये
done ना?
We also done.
Hello. This is
ये रिटर्न ऑन
like you can find in this way also return on assets. Did we do this?
we did only in one way, I believe.
Yes, sir.
No. Okay, then I'll check the videos and I'll confirm whether we did it or not. I'll check the previous videos.
We did it only in one way. You can just cross check return on equity
Okay,
and
okay.
return.
I'll just check it. Yeah, yeah. Then I'll like try to explain this. Almost that set is done. Now like we have the solvency ratio set. Just solvency and leverage if we do, we are done.
So after that, we will practice the sums related to this
We will
problem.
practice like you can take 1 or 2 days. We will start working capital immediately after that. Okay. And
Yeah.
then one any fine day we can put it for practice.
Yeah, because without practice, I can't confirm that I understood everything.
Yeah, no, no. See, you like it's open for you. You can definitely do your practice like from the PDFs what you have now. You can do like what we can do is we can like collectively practice any one of the days.
Yeah.
We can
Definitely.
plan
But
like that.
also we have a doubt, sir. In the
Sorry.
PDF also we don't, we have a doubts.
You
For
can
previous
yeah,
problems
yeah, yeah,
also,
you can
we have
collect.
some doubt.
Of course, when you will be when you start doing, you will get what you get. You keep the numbers, and in the class you ask when we'll be having a like session on questions. Okay. Now the next set is leverage. So that you can ask all your doubts like simultaneously on that day. Some questions I'll be doing, some doubts you can ask. We can do that. Let's start this leverage ratio. See, financial leverage ratio or equity, it's also called as equity multiplier. The formula is total assets by total equity. So this is your balance sheet. 10 lakhs is your asset, total of assets. Equity and debt is nothing but the total of liabilities. We don't say this as total of liability, we say total of stockholders equity and liability. We say like this. Okay. So now if I write 10 lakhs in the numerator and let's say my equity is 2 lakhs and my debt is 8 lakhs, if I write 2 lakhs here, what is the financial leverage ratio?
Fine.
What's the financial
Come again,
leverage ratio?
sir. 10 lakhs into 2 divided
10
by
lakhs
2.
is your assets value and your equity. Okay, let's say your equity is 5 lakhs here. 5 lakhs is your debt. If I write 5 here, I get 2 here, correct?
Yeah,
What does it show?
that is
If
your
your asset,
financial.
yeah, if your asset is twice of your equity,
Oh,
that means half of the assets have been funded by equity and half of the assets have been funded by debt,
Debt.
correct?
Yes.
See, very simply understood. Now, this is a balance sheet. This is 10 lakhs is your total of assets. Okay.
hmm.
Your total of liability is not only total of liability, it is liability and equity combination. So your equity is 5 lakhs, your debt is 5 lakhs. So now when I divide this 10 lakhs of my assets with 5 lakhs of equity, what I understand? my asset is twice of my equity, correct or wrong? It is 2 times or not?
Yeah. Yeah.
That means my asset has been funded by 50%. So it is like the ratio would be 2 by 1. 2 by 1 in the sense my asset is twice of my equity.
Equity.
That means one part of the like 50% of my asset is funded by this equity and 50% is been funded by debt. Correct?
Right.
That's understood fact, no? Yeah.
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 This is fine.
So financial, so let's say this, what is this point about? A company is planning a 1 million capital investment project that it expects to return 15% annually after tax at a return rate of 15%. The net return expected on the investment after tax is $150,000 per year. So what is that company doing? Company wants to invest and they're expecting 15% returns every year. Okay, after tax, let's say there's no tax adjustment you have to do. So that 1 million ka 15% is how much? $150,000, correct?
Hmm.
Yes, isn't it so?
Yeah.
See, you have done a 1 million. See, I don't think you people are attentive. You're not giving me prompt answers.
Sir, are you not able to listen? I said yes, sir.
Okay, I think it's coming too late, maybe. Sorry, yeah. So $1
Yeah.
million is the investment I'm doing, and 15% returns I'm expecting out of this. So 1,50,000 is the returns I'm getting.
Returns. Yeah.
Now, company borrows half of the investment amount, or
5 lakh.
company, uh, uh, where is that? Okay, sorry. Company borrows half of the investment amount, that is of this capital investment they borrowed this much. Can I say this is debt? Yes.
Yeah.
And they have to
Yes.
pay interest of 6%, so that is $30,000 per year. If it
Hmm.
will have invested this much, that is equity, na?
Hmm.
It is equity or not?
Yes, sir.
See, what you borrowed is debt, what you put from your pocket is equity.
Equity only.
Yeah. True.
So that 1 million has 50% debt, that is like 5 lakhs, and 50%
Equity.
equity, that is 5 lakhs.
Right.
And from equity you are getting one, okay, you are getting how much returns? Yeah, you are getting returns of how much from this total investment? 1,50,000, correct or wrong?
Okay.
You getting these
Yes.
returns or not? Yeah,
Yes.
yeah. And from that, what is the payment you have to do for the interest?
30,000.
What is left over with you? 1,20,000, correct?
1,20,000.
Yes, sir.
So if I take this is your money, na? After giving to the
After
debt
tax.
holders. No, after, not after tax. After making the payment to equity debt holders. This is what you are left over with,
Yeah.
na?
Right.
Okay.
Yes or no?
Yeah.
Yes.
This divided by your investment option, investment value, how much you have invested from your pocket, will give you how much returns? Come on, tell me.
Focus.
0.2%. 24%.
Huh? Sorry?
0.24.
Really, madam, your voice is very low pitched.
24%, sir.
Acha, 24. Okay. Now I understand. Yeah, that's it. Just go to this question. Once try to understand what they're saying. They just want to explain you that what is your return on investment. That's it. After making the payments to debt holders. Once you finish, please confirm me.
Okay.
Yes, sir, done, sir.
Okay, then. Okay, Suman, have you finished?
Yes, sir.
Okay, okay. If you are like doing, no problem. You're done, okay.
So
So we'll
that
cut.
this 24% return on its 500 investment, how we get that, sir? 24%? Is it
You do
500?
you divide. See, after you got this is your total income. From that you have removed your debt obligation. That means interest. See, you are the owner of a company, correct? Being
Yeah.
the owner of company, if you are earning some profits, first you need to pay to whom? Debt holders. After that, what is the leftover one lakh 20? This is your profit, na?
Yeah,
And you
1,20,000.
have invested how much? 5 lakhs. The other part is you have borrowed actually. Your total investment is 10 lakhs. I don't deny, but 5 lakhs is the borrowed money and 5 lakhs is your own money. So you are seeing on your own money how much you made. See, you should understand one thing. What they are saying, what's the topic? Example of the effect of financial leverage. See, financial leverage means what? Leverage means taking advantage. Correct? They say now
Mm-hmm.
when you see a cricket match, they say the local team can take the leverage of the pitch conditions. So taking advantage is leverage. How you can take advantage? You can take advantage of debt finance in a very good way. Why? Because the interest what you pay on debt is a fixed nature expense. What is that?
Fixed nature expense.
That means whether see what is the advantage of fixed expense? See, you have a premise. You are paying a rent of 10,000 for this, and you are taking classes for some students. 1, 2, 3, 4, like 10 students. You are charging 1,000 rupees per student per month. So you are getting how much? How much?
Yeah.
10,
Please tell me. You are
1 lakh.
getting 10,000 rupees, na?
Yeah.
Yes.
See, you are paying a rent of 10,000 rupees, and the premise what you have, you can only accommodate 10 students. This premise you cannot increase students more than 10 students. That is a
Right,
constraint.
right,
That is a constraint you have. Bottleneck resource
right.
space. So you're getting 10,000 rupees, and you thought that it's like I'm not able to get good amount of money with this because I'm getting just 10,000 rupees and I'm spending 10,000. Let's say you're taking some course where you're charging 5,000 rupees from each student. Now what happens? Now you will get 50,000. Am I right?
Yeah.
Isn't it
They're
so?
charging 5,000 to 550.
Yes. And what you did is you transformed your room in such a way that you bought more 10 chairs. Now you are paying a rent of 10,000 even though you are teaching one student, even though you are teaching five students, even though you are teaching 10 students, even though you are teaching 20, even though you are teaching 50. It's upon you. Understood?
Yeah.
Yeah.
If you increase your number of students and you're increasing your number of students is giving you more fees, but still you're paying 10,000, na?
Yeah.
This is a
Yeah,
factory.
it's fixed.
Yeah, this is a factory. You are paying a rent of 10,000 rupees. Whether you produce 100 units or you produce 5,000 units, it's upon you now. What technology you use or what, it is upon you. But you still pay only 10,000. Na? So the point what I want to mention you is you can take leverage of this fixed rental expense by increasing your productivity or increasing your revenues. Am I right? Then only you can take advantage.
Yes.
Am I right?
Yes.
Right.
If you are producing 100 units, it's costing you 10,000. If you are producing 5,000 units, it's costing you 10,000. So what is better? And the revenue for 100 units you are getting is 20,000 rupees, and the revenue for 5,000 units you are getting is 5 lakh rupees. What is better? Producing 5,000 units, correct?
Yeah.
Mm.
Paying a rent of 10,000 and earning 5 lakhs, paying a rent of 10,000 and earning 20,000, which is better?
5 lakhs.
That's what. So what I want to mention you is, what I want to explain you is, the advantage what fixed expense has is, it is always fixed even though your activity levels are very high. Okay. Now you see
Yeah.
how we can take the advantage of this debt finance. Let's say company's profit is 1 lakh
Mm.
and this is profit before tax. Taxes are 20,000. No debt. No debt. Okay. And 80,000 is my PAT, and number of shareholders are 10. So when I distribute this 80,000 amongst 10 shareholders, how much each one is getting?
8, 80,000.
Correct or wrong?
Yes, sir.
Yeah.
Here there is debt finance. 1 lakh,
Mm.
20,000 goes for tax, 80,000, 10,000 goes for interest. This is fixed actually. Okay. That means I can increase my revenue
8,000.
more also. I can get 2 lakhs also. Yeah, I'll explain you. Don't worry. So what is happening here? I'm getting 70,000 and there's no shareholders. So the entire 70,000 will be taken by whom?
Oh no.
Oh, no, correct. Let's say you have
Yeah.
increased your profits. That means you have increased your revenues. Like your sales are very high. So let's say the sales are 2 lakhs. 20,000 is the tax. Let's say 1 lakh 80,000. But your interest is how much? Only that is fixed, na?
10,000.
Fixed. So you get 1 lakh
Yeah,
70.
that is
You take
fixed.
total 1 lakh 70 with you. So what I mean to say is
Mm.
you can take leverage of your fixed expenses. Isn't it so?
Yes.
Right.
That's what. Understood now?
Yes, sir.
So this question is saying that you did an investment of this much, 50% you borrowed, is your borrowing, 50% that is 50% is it, 50% is equity, and like you expected 1.5 lakhs as your earnings because you did an investment of 10 lakhs. Okay, on 10 lakhs, 15% you are expecting. That is the total investment. Total investment is how much? How
10
much is
lakhs.
total investment? 10 lakhs. I am speaking that my total investment should give me 15%, 1.5 lakhs. But when I want to check the returns on my equity investment, then how? If I want to check the investment on my,
Return equity.
I want to check the return on my equity investment. For that, what I
Mm.
need to do, I need to remove the debt in the interest what I have to pay to debt holders, correct?
Correct.
Yes.
So what happens if at all you see my earning is 1.5 lakhs, my earning is 2 lakhs, my earnings is 3 lakhs. So what happens? For debt finance, here I am paying 30K, here also I am paying 30K, here also I am paying
30K.
because that is fixed now.
Yeah.
Yeah.
So here I am getting 1.2K, here I'll get 1.7K, here I'll not 1.2K lakhs. Here I'll get 2.7 lakhs. Now you tell me where am I having the highest returns on my equity? If I divide that,
2.7.
yeah, 1.2 lakhs divided by how many share? How many? 5 lakhs. 1.7 lakhs divided by 5 lakhs. 2.7 lakhs
Mm.
divided by 5 lakhs. Now you see here I have the best returns, correct?
Yes.
Right.
Why? Because I'm taking the leverage of this. Now it depends
Right.
upon me how I can take the leverage. Fine. Sure. So like today we will stop here.
Okay.
We'll continue tomorrow. However, the next class is about leverage only. So I'll give you very detailed explanation about this topic called leverage in the next class. Okay.
Okay.
Yeah. Thank you.
All right, sir. Thank you.
Yeah. Thank you. Yeah. Yeah.